how can you become a real estate professional and save a lot on your taxes? What kind of mistakes people make? And even if they don't make a mistake and they become a real estate professional, will they be able to claim the benefits on their tax return? So those are the three major questions that I'm going to answer today. But before I begin, let me remind you guys that regardless of what you learn in today's video, and which I promise you will learn a lot, don't go take any action. Why? Because not everything can be talked about in video. For example, which state you're buying the property in. Is the title going to be under your name, spouse name, partnership name? Is it part of a syndicate? Or what your long-term plans are? Are you going to sell that property or not sell the property? Or your kids going to inherit the property? How are you taking the mortgage? What kind of loan this is? There's so many other things we need to talk about when we're thinking about buying a real estate, because properties have a major implication, not just on your financial health, but on your overall tax situation. Now, why do we buy property? Let's start with that in real estate. Why do we get into real estate market? Well, take a look at the stock market today, for example. Now, I'm recording this. What day is today? Today is February 5th. So February 5th, 2026. If you take a look at the stock market today, if you're in growth stocks, then you got really killed today. Most growth stocks are down by 20 to 40% this year already, just in the last 1 month. In matter of fact, it just all happened in the last 2-3 days. You got really killed. S&P 500 is doing just fine, but only the growth stocks getting killed. Why? Why is that happening? You can come up with a lot of reasons, maybe because of crypto, maybe because of government policies, maybe liquidity, all that kind of stuff. But the reality is it's psychology. What happens is no matter what kind of portfolio you have built, the moment it starts showing a lot of red numbers and large red numbers, people get panicked and they start pressing the sell button. And that is how you lose your assets, because even though you sell out of that asset, once the market turns, you won't be able to buy it back. And that is how a lot of people lose money in stock market. On the other hand, in the real estate, that problem doesn't really exist, because we don't go check every single hour what is the value of a property. Most people buy the property because they're going to hold it for at least a year or longer. Very rarely you'll see people trading properties unless you are specifically into a construction business. And that is why people are able to build really good long-term wealth in this country with real estate. So that's number one. It's really great. Why? Because real estate allows you to use leverage, really, really good leverage. Leverage is usually not good. If you're taking leverage in a stock market or elsewhere, that can be very problematic. But in real estate, that can be very, very good, because your renter will be paying for that mortgage and you own the property. Great. And number two, over time, your rent payments are decreasing because you're paying off a lot of that principal balance. And now you're actually building equity. So your renter is actually helping you build equity. Number three, we naturally in this country will have inflation. So for example, right now inflation is somewhere around 3%, sometimes 4%, sometimes 2%. But the government likes inflation. This is how we inflate prices for everything. So people love inflation, and that's why there will be continue to have an inflation over the next 10 years, 20, 30 years. That means the property prices over a longer period of time will continue to go up. There is significant tax benefits when you buy real estate. And that's perhaps the main reason why you're thinking about becoming a real estate professional. So there are a lot of great reasons. You're able to generate large amount of paper losses buying in real estate. For example, in 2026, we have bonus depreciation. You still have your regular depreciation. You can write off your taxes. You can write off your mortgage payments. You can write off maintenance. You can write off repairs. You can write off, anything else that you do to the property. So you can generate large amount of paper losses. But problem is that by default, if you're buying a real estate, you're considered a real estate investor. And real estate investors are passive in nature. That means you're basically making money with money. You're not really putting your sweat into that activity. And that is why IRS thinks that they are going to let you write off those losses against your passive income, which a lot of people don't have. So if you're just a simple real estate investor and you buy yourself, let's say, $1 million property, and it generates, I don't know, $300,000 in paper losses. You have those paper losses, but you can't really claim them against your W-2 income, because your W-2 income is active income. And these paper losses that you're generating is passive losses. So that gets you in a little bit of trouble. Now, does that mean that you lose that benefit? No. Basically, when you file your tax return, we record it and we put it in a box. And we let the IRS know that, hey, this benefit is sitting in this box. Whenever you sell that property, we can open that box and use those benefits. Or at some point when you do have passive income, then we can offset that passive income against those losses that you're been carrying over for whatever number of years. So you don't really lose the benefit. But what's the point of claiming the benefit if you can't use them? I would rather use them today. And that is the reason why you want to become a real estate professional, because you want to use those benefits today. Now, one subtle difference between being a real estate professional and a real estate investor is that real estate investor usually owns a property. They're the owner. But real estate professional doesn't have to be an owner. They could be in development, construction, acquisition, rental, management, leasing, brokerage. They could be in a lot of those activities. Give you an example. Let's say husband owned the property, okay? And the wife can be a real estate professional. Completely okay with that. Nothing wrong. Just works fine. So real estate investor has to own a property. Real estate professional doesn't necessarily have to own the property. Can they own the property? Absolutely. If a real estate professional has a property, that they can generate a lot of paper losses, and real estate professionals can take those paper losses against a W-2 income. That's a very powerful combination. And that's why it works very well when husband has or wife has, one of the spouses have a good active income and the other spouse is a real estate professional. So now there's a good, powerful force. You guys can work together to create a lot of tax benefit for yourself. And then it allows you to build wealth over time. You can, buy a property this year, maybe you buy another one a couple of years down the road, and so forth. So one thing for clear, you understand the difference between a real estate professional and a real estate investor. Requirement number one, if you want to become a real estate professional, that means you're spending more than 50% of your time in a real estate trade. What kind of trade? Development, construction, acquisition, rental, management, leasing, brokerage, all those kind of activities. That means you're spending more than half of your time. So if you're a W-2 employee and you're working for somebody else and you want to claim yourself real estate professional, it would not work. Okay, because you're spending most of your time in other activity, not in real estate. That's why I said it makes sense if one spouse is on W2 and the other spouse is not on W2, it is best for them to become a real estate professional. Number two, if you are an accountant like myself or you're a lawyer, then you do not automatically qualify as a real estate professional. So be very careful with that as well. Now, what are some of the requirements for becoming a real estate professional? There are two major requirements. One requirement is that you need to uh, spend more than 50% of your time in real estate trade or business, like I said earlier. So that means if you're a W-2 employee, that would not work for you. And you need to spend more than 750 hours per year in those activities. So like I said, development, construction, acquisition, rental, management, leasing, brokerage, those kind of things, 750 hours. And you need to record that time log. So if you claim yourself as a real estate professional and you don't have that time log of 750 hours, that can get you in a lot of trouble. Now, let's just say you don't do anything else. You are a licensed realtor. You have an office. That is all you do. You're doing plenty of transactions. It's so obvious that you're fully engaged in real estate business. I doubt it that IRS will give you a really hard time about the hours, because that is, you're spending your entire time in there. But for most of us, where this is not exactly what we do, that means we're claiming ourselves real estate professional because we're managing our own properties. In those cases, it's extremely important for you to log every single hour. And then don't go log like, 1 hour here, 2 hours here. Like, be specific. 1 hour and 30 minutes. Like take a stopwatch and actually keep a log of how many hours did you really spend on it. So that's number one, right? You got to be more than 50% of your time spent in real estate profession. Number two, you need to spend 700 and that would make you a real estate professional. Okay. So now we got through problem number one. Problem number two is material participation. So material participation, you can spend 500 plus hours on the property. So each property basically requires that you meet the material participation rules. So if you own 5 properties, technically speaking, you need to meet this for 5 properties. And like I said, there are 2 ways to do that. Number one is 500 plus hours on the property. And number two, 100 plus hours on the property, but nobody else spends any more time than you do. So that means you need to track your hours as well as everybody else hours. And this is where people make a critical mistake is, they might spend 500 hours on a property, which by the way, you should automatically meet that requirement if you're considering yourself to be a real estate professional, because the requirement for real estate professional is 750 hours. So that should be given. This is the requirement for material participation. Now, what happens is when you file your tax return, we are going to say all of these hours that is spent on multiple different properties, let's group them all together, and together you are meeting that material participation requirement of spending 500 plus hours on that property. And like I said, if you're real estate professional, most likely you already have those 750 hours anyways. Now, this is how this thing works. So if you have multiple property, then you're not making the grouping election, that can get you in trouble. If you are on a W-2 and you're claiming yourself to be a real estate professional, that can get you in trouble. If you're not keeping a proper log of hours, that can get you in trouble. Sometimes I see people logging activities that have nothing to do with real estate per se. For example, they log a lot of hours for traveling or reading books or learning or schooling, this and that. Those things are great. But really, when it comes down to this, IRS is really looking for how much time did you spend on that particular activity, not all the supporting activities. That's not what they're looking for. If you're doing repairs, yeah, that's fine in the property. That can work as well. Now, some of you guys who make less than $150,000, even if you're not a real estate professional, you might be able to still claim some of those passive losses against your active income. And not much, like about 25,000. So it doesn't really help a whole lot, but that can work. So that kind of gives you an idea as to how the real estate professional status works. And there's another way, which is called short-term rental loophole. So we can talk about that maybe separately. So if you don't meet all of those stringent requirements, then you can look into that strategy as well. All right, guys, thank you so much, and I'll see you soon.